Thanks very much for joining the Simplicity webinar on the markets update. I'm joined by my esteemed colleague, Andrew, who's our Chief Investment Officer. G'day, Andrew.
G'day. Hello, everyone.
And Andrew is awesome at managing all of the questions. So I've got about a bunch of slides just to talk with you about, and then we will go into questions and answers. And we typically will hang around for as many questions and answers as you have. So we have a sort of a last person standing rule there. So please do not be offended if you need to sort of head off and do something else. We'll just carry on answering questions until all the questions have been answered. So I'm just going to share screen here for a second here and just talk through some slides with you. Here we go. All right. And I'm just checking, Andrew, we can see that. You can see that?
That's something.
Okay, folks. All right. Let's just talk about basically the market updates, because clearly it has been a very tumultuous time in markets. And what we wanted to do was to present you with a perspective on the markets, what is happening and why, what you can do about it. And then we wanted to have a chat about a big initiative we've got in basically helping address the housing crisis in New Zealand, and talking about what we're doing there, because we're doing some very significant things now. But just a reminder of who we are. Obviously, we are a non-profit owned by a charity. So we're going to be around here for 100 years, and that really influences the way we think about investing and making a difference to New Zealand. We give 15% of our fees to charity. That's now over $150,000 a month, or about $5,000 a day to charity. And we've given almost $4 million since we started around my kitchen table 5 years ago. We do KiwiSaver, and as you know, we're a default provider. We do investment funds, first home loans for members as well. And now we've just started on affordable housing, which we'll talk about. Most important thing here is this is a 100-year view. Because we're a non-profit, we'll never make a dollar. Because we don't make any money, we won't be worth any money to a purchaser. So we'll never be bought or sold. So if you think about it as a sort of the Southern Cross of finance, you're not far off there. Just an update on where we are right now. As of today, our website updates these numbers every day, and that also updates all of your accounts and your holdings and what you own every day. You can go and look at it. We now have 123,000 members. We have about $4.2 billion of funds under management, and we're saving the average member a little over $300 in fees a year, which is great. And as I mentioned, almost $4 million to charity. So inflation, interest rates, and war. Boy, is a lot going on. And I just wanted to talk about what is a very, very unpredictable world, because since 2019, can anyone remember that far back now? We've had COVID, we've had an invasion of the Ukraine by Russia, we have inflation, which is rocketing ahead, and supply chain chaos as well, which is also helping put prices up. And yet it's been really weird, because in that time, the US market has gone from down almost 60% to up 16% in 2020, up 27% in 2021, and down more than 15% so far. And in fact, we're just on the cusp of what we call a bear market, which officially means the market's down 20% from its all-time highs. So it all looks pretty scary out there and very unpredictable. However, those who forget the lessons of history are doomed to repeat them. So let's look at history. Let's look at, this is the slide I always put up in every single presentation. It's a 130-year view of the United States stock market. And as you can see, there have been some massive ups and downs. That's the blue line. And in fact, it's interesting, if you look at it in percentage terms, which is what that fancy term called log scale on the right means, in percentage terms, actually the coronavirus blip right up at the right there was bad, but not that bad in the context of history. And what we've just seen in the last couple of months, which is down about the same as coronavirus, this slide is a couple of weeks out of date, that is the same as well. It's around about a 20% drop, which in history is not that bad. The global financial crisis was much worse. You see that the Great Recession that went down a lot more over a lot longer period of time. And look at it in context to the Great Depression, where the market went down 80%. So the interesting thing about this is you have to accept that there will be ups and downs in financial markets, and there are plenty along the way. Just look at any tiny time frame, and particularly look at those grey bars. Those grey bars are when recessions arrive, and typically around recessions you'll see reasonably significant drops in the market. So this is not unusual in the context of time. There's nothing particularly to be worried about right now, but you will see that it goes up and down. Now, over the long term, financial markets go up. And they have to go up, right? Because that's capitalism working. If the financial markets didn't go up in the long term, no one would be in them, right? So the reason that markets go up is because productivity goes up, technology comes along, people want to build a better world, they start businesses, they make profits, they pay dividends, all that good stuff happens over time, but it's a little bit of a roller coaster. Now, as you know, when you're on a roller coaster, once you're on it, don't get off it, right? Stay on the roller coaster. So, and that is the underlying message right now is, regardless of what you've seen in the short term, the long term, the trends are very much in your favor. So why are the markets going down? Well, it's, interest rates are rising, right? When interest rates go up, typically share markets go down. And when interest rates go up, the value of fixed interest, particularly long-term bonds, also goes down as well. So why are interest rates rising? You can see that rise there. This is the New Zealand 10-year government bond yield. On the right there, since January, it's gone up quite a lot. But as you can see, where we are now in history is back to where we were in about 2017. It was only 5 years ago. So it's not like this is that massively unusual in the context of history. And have a look at that chart too. You can get some big spikes in interest rates from time to time. But why are interest rates rising? Well, the first one is inflation. We've clearly seen high inflation come. You see that big blip on the right-hand side there. And that goes, we have to go right back to sort of 1990, 1991 to see rates of inflation that high. Although, as you can see, all the way through, it's not uncommon for there to be inflation shocks that come through in the system. See that one in March 1999, we had deflation partially there. We had a huge rise up there. So what we're seeing is it's risen surprisingly quickly, but the magnitude of it is not that surprising in the context of history. But clearly inflation's there, right? Cost of everything's going up. The block of tasty cheese in my supermarket the other day was $18, and then I opened the papers and saw that it was $21 somewhere else. So that's driving up. So interest rates are driven by inflation. And why is inflation going up? Well, just mentioned the cost of living. This is just a chart showing the cost of transporting a container from China to America. As you can see, it's gone up. At its peak, it was almost 10 times more expensive. Went down again. Then we got the second wave of COVID. It came up again. Now it's going down again, but it's still miles above where it was. So there's a lot of cost in the system all the way through. You can see it in the supermarket shelves. You can see it in pretty much anything you buy, price of petrol and so on. Cost of living is going up. The other reason why there's inflation and why we've got higher interest rates is because of massive government spending to prevent COVID. Now, this is an estimate. Those blue lines are the percentage of GDP for each of those countries that they spent on COVID relief. In some cases, say Japan, 53% of GDP. It all adds up to over $9 trillion. In fact, the latest number I saw was $12 trillion. And it's amazing how the world can't even add that up correctly. So much money spent in so many ways. But that's the equivalent of like printing $9 trillion, sticking it in a helicopter and throwing it down. And when people get that money, when you print that amount of money, unless there's the goods and services to soak it up, unless there are more factories, more goods, more cars, more everything to soak that money up, price of everything goes up. And of course, in COVID, when they were printing all that money, that's exactly the time when we were closing factories and shrinking supply, and stuff was harder to find. So it's no surprise that the price goes up there as well. So a lot of spending. The other reason you get inflation is because of war. And if you look on the left-hand side, all of the big wars that we may have known or read about or studied in school, all of those wars were inflationary. Wars are typically inflationary, although it's interesting that inflation typically drops when the wars end. But if you look at Russia and the Ukraine on the right-hand side there, they export an awful lot of stuff that we need and use, and where the price is going up. So war is unquestionably inflationary. However, having said all of that, once again, those who forget the lessons of history are doomed to repeat them. Let's have a look at the inflation in New Zealand since 1960 right through to now. And you see those really outrageously high rates, up 16, 17, 18% back in the early 80s and so on. That was the time when inflation was running rampant. Things were kind of crazy. I've been running this competition and doing roadshows all around the country. The highest mortgage rate paid by anyone during those times. The highest rate we've got so far is 26%. So it was very, very uncertain times. That was what we called the Great Recession. And high inflation like that means job layoffs. It's hard for people to invest in businesses and growth because they don't know how they can price goods. Very destabilizing. So around about that time, all around the world, governments and reserve banks got together and decided to get inflation under control. And that's when the Reserve Bank Act was passed in 1989. Now, I can't think of many more boring things to read than the Reserve Bank Act of 1989, but equally also, Andrew, pretty much agree, it's one of the most important pieces of legislation we've ever had in New Zealand, right? Just, yeah, hugely important. And that happened all around the world. And once reserve banks got involved and they were said, your job is to keep inflation under control, that reserve banks around the world, including our Reserve Bank, have incredibly powerful but very blunt tools to get inflation under control. They can't fine-tune it. It's not like a surgeon's scalpel, but they can certainly bring it under control, and look what they've done. Now, it's burst out of that range that they've set for inflation of 3% or below every now and again, and then the reserve banks come in and have brought inflation down. So I would just caution people who think that inflation is going to run rampant and out of control, that this is not like the past. This is not, you're not actually going to repeat the high inflationary times in history. Well, you may, but you now have a new sheriff in town, reserve banks, and their job is to get inflation down, and they have been remarkably successful at it. And so, where will the markets go from here? It's very difficult to know. When you've got war, when you've got cost price, when you cost pressures coming through, when you've got inflation, and you've got people at the moment have been, I wouldn't quite call it panicking, but they've been extremely nervous and uncertain about what the future is. That is still an uncertain future, although I would say that over time, the financial market's getting a little bit more used to these things. They'll build them in, businesses will adjust, people will adjust. So it's unlikely to be as surprising as it's been in the last few weeks and few months, but it may or may not be better. We just don't know. But I would say this is one of my favorite quotes from Mark Twain. I'll just let you read that for the 30 seconds. And so what Mark Twain is saying here is, as soon as it becomes the consensus, be very, very careful about acting on the consensus. And remember that with the media, pretty much if it bleeds, it leads, right? So you like to hear the bad news in the media before you'll hear the good news. And so anyone who says inflation is out of control, it's going to stay out of control for a long time, price of goods is always going to go up, all of those things, be very, very wary about making the decisions in life based on that, because that's usually when things turn the other direction. And I'll just take you back a couple of years. Remember when we believed that house prices would go up pretty much forever? And everyone thought the housing market couldn't possibly go down because there weren't enough houses, because interest rates would stay low forever, all those sorts of things. Well, that turned out to be wrong. Likewise, people who are unbelievably bearish may also be wrong as well. So what can you do though, right? If we say there's an uncertain future, Sam, you're not telling me where the market's going to go, because I always have no idea where the markets will be. What can you do? Well, let's look at the impact of inflation over the long term on your investments. If inflation rises and interest rates go up, typically it's pretty good for shares because companies can reprice their goods over time. And it's typically pretty good for homeowners too, because the price of houses goes up, yet the amount of money that you borrowed to buy that house stays the same, right? Remember the principal you borrow. So if the house price goes up and your salary goes up, the amount you borrow is actually less. And in fact, people who bought houses when their mortgage rates were 20, 25, 26%, they're still very happy they bought those houses because their salaries went up and the amount that they borrowed to buy that house stayed the same. It's a little bit more mixed for bond markets and for fixed interest markets, particularly long term there. We can go into that later on in detail if you want in the Q&A. That's a mixed message. But if inflation and interest rates fall, it's pretty much tailwinds for all financial assets. And that's what we've seen in the last 10 years. It's good for shares because ultimately the dividend shares pay are more attractive than bank deposits, so people buy more shares. It's good for home prices because people can borrow more money because interest rates go down, so house prices go up. And it's good for homeowners. It's very bad for people who are saving for their first home. And it's good for long-term fixed interest investors as well. Bond prices tend to go up when interest rates come down. So that's the impact of inflation long-term. It's a confusing market in the short term, and you've seen share prices go down, but over the long term, it's actually pretty good. The first trick is diversification. You don't have to read any of this chart, just look at the colors. And this shows the best performing at the top and worst performing asset class for every year since 2012. And if you pick any color, dark blue or pink or light green, anyone, as you can see, it's very, very, very hard to predict from one year to the next how well each one of these asset classes will do. And in fact, if you try and pick that, it's pretty much a fool's game. Try to work out where financial markets will be. Well, let me ask you this question. Do you know anyone who knows what it will be for 2022? Nobody knows. Everyone's sort of guessing or making educated guesses at best. What that actually shows you, though, is that if you own a little bit of everything, that means that you will ultimately benefit, because ultimately long-term financial markets go up and you may have some losers, but you'll have more winners over the long term. The value of your investments can go down short term, but by diversifying, that whoever wins, you'll own some of it. And the other most important thing is it lets you sleep at night, right? Because there's this thing in investing called loss aversion. It means that you hate losing a dollar more than you love making a dollar. So as long as you go to bed at night thinking, I haven't got all my bets on one asset class or one investment, that means that even if things go down, I know I'm protected by diversification. And ultimately, when things go up again, I'll own some of them. So we have, in our balanced funds, we have 3,000 investments, more than 3,000, in fact, in 23 countries. And it means I never lose a minute's sleep worrying about where your investments are, because they're very diversified. It's a free gift in investing, diversification. It gives you peace of mind, and it also makes sure that over the long term you win. The second thing is focusing on fees, because fees really matter. This is the lifetime cost using current fees of the average New Zealander, what they would spend on their mobile phone, $22,560. You can see down the bottom how we've calculated that, and we're happy to show you these slides. That's from the industry body. So that's actually quite a large number, eh? Then you look at the lifetime, what you would spend on power if you took today's fees and you were the average person over your lifetime, what you would spend on power, 36,000, that's huge. Guess what it is for KiwiSaver? In a balanced fund, this is someone who, who's saving from 18 to 65 on an average salary, paying 3% into their balanced fund with their employer paying 3%. Right? Now, this obviously assumes that fees don't change for your whole life, but it's an interesting comparison, isn't it? That you would end up paying a whole lot more on KiwiSaver fees than you would in power bills and mobile phone charges at today's rate of charging. So why is that? In fact, I can show you, here's an example. If you look at our balanced fund there in the middle, the average, I told you, lifetime fee was $44,251. So this is from the Sorted website. So it's an authoritative independent source. As you can see, we charge $14,000 in fees over that same lifetime. This is for a 20-year-old earning $50,000 a year, retiring at 65. If you look at a growth fund, the fees can be $71,000 over a lifetime using today's charges. We would charge $18,000. Conservative fund, average would be $33,000. We charge $11,000. So as you can see, fees really matter. They are a huge contributor to your wealth. So most important thing when you get into a recession or tough times, it's like shopping anywhere, folks. You want to go and find cheaper food. You want to find the same food at a lower price. Likewise, you should be shopping around and trying to minimize the fees you pay and the power bills you pay and the phone bills you pay. In fact, there's a really, really good comparison tool that's just been listed on the site Money Hub that's worth looking at if you want to try and minimize your power and power bills and phone bills. Here's the other thing you can do. Don't try and trade the markets, just save. Because I'm going right back to that chart I was showing you about the US stock market. Every single time the market goes down, if you're a regular saver, you're getting more for your money. As Warren Buffett would say, when the markets go down, I rejoice because investments go on sale. So you are actually buying more for your money. So you want, over the long term, if you want to make more money, you want financial markets to go down so you can buy more for your money at that stage. And remember that if you already have investments and these things have gone down and you look and you say they've gone down, you have not lost the money until you take your money out. You don't crystallize the loss until you sell the investments. Until then, what you're looking at is the theoretical value of those investments. So if you are a long-term saver and have long-term holdings, long-term, the trend is your friend and you'll be okay. If you are a regular saver, this is fantastic because you're buying investments on sale. So the most important thing is that diversity slide I showed you, picking the direction of financial markets is a fool's game. Or let me ask you this question. Where are they going to go to from here? Nobody knows. I don't know. So if you are saving, though, if they go down further, you'll get more on discounts. If you're holding investments and worried about it, don't worry, long term, the trend will be your friend. And the most important thing then is to make sure that you're just in the right investments and in the right fund. Go to Sorted, go to Money Hub, go to a respected source, go to a financial advisor and ask, am I in the right fund for me long term? Here's an interesting too about saving. This is what I call Einstein's advice, or this is another way of putting this is the Sam Stubbs Get Rich Slowly plan, right? If you go to the Sorted website and you work out what a cup of coffee costs. So here's what I do for my kids. This is one way to reliably get wealthy over the long term. If you think about a price of a cup of coffee, which today is around about $5, if you save the price of a cup of coffee every day from you're born to your 65 in a growth fund, you would end up having an inflation-adjusted dollars. Because remember, the price of cup of coffee will go up, so you will save more as you progress through life. But it will only be the same amount out of your salary or your wages, right? So you're saving the same amount. At 25, you'd have $81,000. It's a pretty decent house deposit now. And at 60, if you saved until you were 65, you'd have $655,000. Now that's in inflation-adjusted terms. That's why Albert Einstein called the eighth wonder of the world compounding interest, because all this is doing is seeing the compounding effect of that cup of coffee that you've saved every day. So that's what I do for my kids. I save them the price of a cup of coffee every day into their KiwiSaver accounts in a growth fund, in the reasonable certain knowledge that they'll end up with around about that amount of money. It's an incredibly powerful way to get rich slowly. I just want to talk about our housing crisis now, because we're clearly in one. And even though we've seen house prices drop, a lot of people are doing it really tough out there. And we started to think, you know what, given that we have billions of dollars of members' money to invest, and given that we will hopefully have many more members and a lot more money over time, and we're going to be around here for 100 years, and that typically in Europe and America and Australia, pension funds and KiwiSaver funds like ourselves invest in rental housing, we thought, could we actually do this and help make good returns for members? So how could we help with the housing crisis and make good returns for members as well? We're doing it now in three ways, in three really significant ways. The first one is with Simplicity Living, which we announced in September last year, we are now building affordable homes. We already have the first 111 under build right now in Auckland. We have purchased land for the first 600, and our long-term aim is to be building over 1,000 homes a year. And we want to build and own them for 100 years. So build them really, really well. I mean, out of concrete and brick, warm, dry, affordable housing. We're aiming for a carbon neutral construction, even though we're using concrete, by offsetting that with native trees. But we also have a huge amount of waste reduction as well. We run it very much like almost like a Toyota factory, a Kaizen approach to manufacturing on site. And what we want to do is do affordable long-term returns. Affordable long-term rentals for members and non-members, but a place where you could rent if you wanted to for the rest of your life, because that's what you can do in Europe and elsewhere in the world. And it also provides very reliable long-term returns above what we would get in the bank, which is really, really good for the members who are providing the money, and awesome for the people who are renting the places as well. And you can see in the top left-hand there, that is the sort of housing that is already being built by NZ Living, which has now become Simplicity Living. And as I say, we have the first 111 in build, and there are already about 750 of those equivalent homes in Auckland already. So you can see, feel, and touch them. And down the bottom left-hand corners, those are the ones that we are actually building and that you, the members, are actually funding. As I say, our aim is ultimately to be one of the largest landlords in the country, ideally the second largest after the government, providing tens of thousands of New Zealanders with warm, dry, affordable homes to rent. So that's the first thing we're doing. It's really significant. The second thing we're doing is first home mortgages. And we've now been doing this for about 2 years. And you can see that orange line down the bottom is what we have charged for mortgages versus the black line is the average bank 1 year rate. The grey line is the average bank 2-year mortgage rate, and the average blue line is the average bank floating rate mortgage. As you can see, we have been consistently cheaper than the average mortgage rate. And on average, we think this has been saving our members who've been borrowing from us to buy their first home about $100 a week in interest. But also it's been improving the returns to our members, because instead of giving the money to the banks, putting it on bank, a deposit on the bank, and having the bank lend it and make all the money, we've just been taking that money and lending it to members directly. Just like building societies and thrift societies have been doing for hundreds of years. This is not a new idea. Simplicity does not invest our members' money in new ideas. We just do what's worked overseas and we bring it to New Zealand. And as I say, this has worked for thousands of years, this idea of members lending to members. So that's the second thing we're doing. We're building affordable homes for rent. We're lending to first home buyers, and we only restrict it to first home buyers because we would have way too much demand if we were lending to everyone who owned a home. And that's first home buyers need the help the most. The third thing we're doing is helping fund the building of community housing. We've already committed $20 million. This is community housing providers, typically non-for-profits, who will lend all over the country. The lending is highly secure. It's not literally government guaranteed, but and Andrew can explain this if you wish, it's effectively government guaranteed lending. And it's very secure. So our members are getting a fair returns, and we're helping build a whole lot of houses all around the country for people who couldn't otherwise afford to either rent or buy a house themselves. So I just wanted to leave just with one other question. Is the future scary or cheery? Because right now you look at financial markets and you go, oh, it looks pretty scary out there right now. Actually, in the context of New Zealand, I think the future looks very cheery indeed. In fact, I'm going to make one prediction. I think the next 30 years in New Zealand will be perhaps the best 30 years to have ever lived in this country. And the reason is grounded in fact, and it's actually all about how KiwiSaver is changing New Zealand slowly. It's becoming a massive savings pool. 14 years ago, New Zealanders didn't have $1 in KiwiSaver. It was just an idea in Michael Cullen's head. 14 years later, we now have almost $100 billion saved. And Treasury tells us that could be a very significant amount of money by 2030 and 2050. And we've seen this happen in Australia, right? When they started doing this, Australians, when they started saving in the super fund, they now have $3 trillion. They have 30 times as much money saved as we do in New Zealand. And if you can see that, that's how the Australian economy went for 26 years without a recession up until last year. Even though Australia, like New Zealand, was a commodity country, normally we have booms and busts when the price of commodities go up and down. No, it was a very smooth growth in Australia because their pension money kept on getting invested in the country, invested in new companies, invested in building, invested in large companies. And because the money kept on getting saved by Australians, they kept on investing it every single day. So even though you had a recession and the markets went down, they kept on buying companies and investing in Australia. And we've seen that in with Simplicity. All through COVID, we've just had net money coming in every day because you've all been saving a little bit every day, or our KiwiSaver members have. So we've never had a day where we've actually been a net seller of anything. We just carried on buying. And of course, that's a very, very powerful force. It's like a rising tide. You don't notice it day by day, but it adds up to being a huge amount over time. And in fact, if you have a look at it, I can just give you some numbers. It's over 2% of GDP a year we're saving right now. We've never saved that much in history. And over time, I think we will have the same effect of this that Australia has seen, Singapore has seen, the Scandinavian countries have seen, anywhere where they've been investing a whole lot of money over time in their pension funds. So it's a very, very good news story. To give you a really tangible example of that, look what Simplicity is doing with the affordable housing we're building now, and we can afford to do that. Remember, that very long-term projects, we can do that because we now have the security of money coming in every day. And remember, that doesn't matter what happens in the housing market. We will be employing builders, employing subcontractors. We will be building those houses, as it were, through any down cycle, and that helps smooth out economic growth over the long term. So it's actually a very cheery time. If you have a child or a grandchild right now, they are entering in New Zealand. Well, I think they just chose their parents and grandparents very well, because I think they'll be entering a period of real economic renaissance in New Zealand. You saw it happen in Australia. You've seen it happen elsewhere in the world. It's just happening here. So I'm going to pause right there, and we'll stop the sharing. And so, Andrew, we can chat.
Great, thanks, Sam. And so, just in case anybody's not aware, if you want to ask a question, please go onto the Q&A button on Zoom and send us a question. We've got a few here to work our way through. If you're on Facebook, do send one through, and one of our team will pass them on to us. So, starting from the beginning, from question from Wilson, simplistically asking, is now a good time to put money into our Simplicity accounts given the slight dip in the price of Simplicity units? So hopefully your presentation has answered that one, Wilson. Fundamentally, our view is that the best way to do things is just keep dripping a little bit consistently over time. Somebody anonymously asks, can anything be done to stop the drop in the value of bonds and fixed interest in funds? And do we see them rebounding sometime? I'm probably best place to answer this one, I think, Sam. There's nothing we can do to stop the change in valuations, but what's really important about what's happened over the last 6-9 months to a year as interest rates have risen is you've seen the value of bonds go down. That's because interest rates are rising. But what happens at that point is that as interest rates rise, you're actually getting a little bit more insulation, if you like. The return on bonds is going up on a daily basis. And so, as I say, you've just got a little bit more of a cushion now. Interest rates for 10 years in New Zealand are up to around 3.5%. They got below 1 at one point. And what that means is that every day they're ticking away at 3.5, and that's going to gradually improve things. We certainly seem to have found a point at the moment where interest rates have steadied. So there's a bit more insulation now than there was.
Yeah, and I think the other interesting thing, Andrew, is just to remember this is a theoretical drop in value, right? So we own a whole bunch of investment grade bonds. We have every expectation that every one of those bonds will be repaid in full, right? It just means that the interest rate we're getting on that bond is less than somebody could get right now if they're investing new money. So we'll still get all of that principal repaid and that interest repaid. So you've had a theoretical drop in value, which means that if you sold everything today, that's what you would get for it. But if you carry on holding them, you'll get your money back and you'll get interest. You'll just get a little less than you otherwise would have. So it's really important in these times to realize that you haven't lost money until you sell the investments. They've just gone down in theoretical value. That's what's happened. Yeah.
Sure. Thanks, Sam. Question from Dan. Hi there, as a long-term member, I'd love to see Simplicity Home Loans made available to long-term members for their family homes, not just first home buyers. Would we ever consider this?
Yeah, that's a very good question. So here's where we are at the moment. We have just had $100 million in first home lending. At the moment, with the size we have, we could probably lend a total of, Andrew, it's about $150 million. We could probably get about another 50 million of lending capacity. If we said tomorrow, oh, we can refinance everybody's first home, family home, we would probably have, well, I know we would have billions of dollars worth of demand because there's about $282 billion worth of first home loans out there. We're by far the cheapest. Oh, and sorry, let me rephrase. We're not always absolutely the cheapest, but we are incredibly competitive over a long period of time because some people have special offers and one-offs and all those sort of things. So we never say we're absolutely the cheapest, but over the long term we're incredibly competitive. So we know that we would be swamped with demand. We just could not possibly fill that demand. So what we decided to do is say, listen, we're starting this slowly. We're going to be doing this for a very long time. We'll make it available to first home buyers for two reasons. One of all is that those are the people who most need the help, I think, and also from an investment point of view, because we are charging almost, if not the lowest rate in the market, we've got to make sure that the lending is very secure. And the most secure form of lending that any bank or any lender can do is to first home buyers, because you'll basically go hungry rather than not pay the mortgage because you need a roof over your head, right? This is your home. So that's why we do it. So I don't think that's going to be possible for quite some time, if ever. But on the other hand, the bigger we get, the more lending we can afford to do. Maybe we'll consider it in the future, but certainly not planning to right now.
Great, thanks, Sam. Right, this is a reasonably long question from Chris, but I will quickly read it through because it's quite important. I wonder if we're on the cusp of looking at a more systematic change in financial markets, one that might see permanent change where the market never fully recovers. In other words, a variation to the capitalist model. Your position assumes we are going to work on the same capitalist model. Economist Tyler Cowen says to correct inflation, history has shown a recession is required. Please, have you got any comment?
Sure. Well, I guess the question is this time different? And my short answer is no, this isn't different. To answer your question about capitalism, I agree with Winston Churchill. It's the worst form of economic organization, except for all the others, right? So it's an imperfect model, and it leads to recession, overcorrections and undercorrections at times. And we're going through, look, you could call this a recession if you wanted to. You could also call this a very healthy market correction as well. Two different ways to describe exactly the same thing. So no, I don't think this time is different. I don't think things have fundamentally changed this time. I think that we've found out over quite a few centuries now that this thing we call capitalism, and then, liberal capitalism or capitalism, or, middle of the road economics, whatever you want to call it, actually seems to work pretty effectively. It's just that at times it gets exuberant, as it has with house prices, for example, and markets over the last few years, and it needs to go through a normal, proper and healthy correction, which is, I suspect, what we're going through right now. But look, I don't know what will happen there. All I know is that if you diversify and you pay the lowest fees and you look at the very long-term trends, you'll be okay.
And the question about a recession being required to get rid of inflation, Chris, in that instance, as Sam showed, there is a little bit of a change in the way things are managed nowadays, so that we shouldn't need to, the Reserve Bank shouldn't need to create a real deep recession, but a slowdown in economic growth is inevitable. And if that causes hopefully a soft landing, then that's quite possible. Question from Ian: if I have a lump sum ready to invest now for the medium term, should I buy all now or drip feed it over the next few months? So
we can't give you personalized advice, so I'll just give you sort of the general advice I give to most people who win lotto or get a lot of money, is you drip feed it in over a long period of time. And that means that you really don't, because you could get it wrong timing wise, but if you're a very long-term investor, it doesn't matter too much. But dripping it in means that you kind of feel okay if the markets go down a bit in the short term, because you've got some more in cash and you'll buy at lower prices, and you don't feel too bad if the markets go up because you've got some invested. It's more actually, funnily enough, it's almost as much psychological as it is financial logic to be dripping it in over time. Because you don't want to go through that, that loss aversion thing I talked about, how you hate losing $1 more than you love making $1. So as a general rule, drip it in over time and you'll feel okay. If I won lotto tomorrow, I'd actually do it over a number of years, not even months or weeks. And I just, feel comfortable knowing that every week a little bit was going in.
Another quick one from Chris. I'll cover this quickly. Today's market seems unique because all asset classes are losing. It's true that some are losing more than others, but they're all in decline. Is this right? Well, it was right, Chris, in fact. And in fact, bonds were the weakest of our investments for a little while, and then shares began to sort of join them. But as I said a couple of months ago, with interest rates now having risen, there is a bit more. There's a bit more of a cushion for fixed interest or bonds, and so I'm not expecting to see the losses there anywhere near as bad as the losses can be in shares. So I think you're going to see a return, at least to some semblance of normality.
And if you believe in history, it's never all bad or it's never all good for very long, right? So when all asset classes go down at once, that usually doesn't last for very long. Likewise, if they all go up at once, it doesn't last for very long either. So although, there are times, and we've had the last 10 years have been pretty spectacular for pretty much every asset class over there, but that's been pretty unusual in history. Funnily enough, what we're going through right now feels a little bit more normal to me than it did a few years ago, but you just don't know. You just don't know.
On the chat, we've got a question. Who's this from? Sorry. from Stephen, why are we seeing a big sell-off in NZ shares? Stephen, we're not really specifically seeing a sell-off just in New Zealand shares. Shares are going down globally. It seems to be going in fits and starts depending on the sort of theme of the country concerned. So the US is the bellwether, that tends to be going up and down fairly much every day. Our market occasionally gets a bit more support because it's soft commodity based. Australia sometimes has been slammed because it's obviously got a more of a resources base. But I don't think the sell-off is in any way limited to New Zealand. I don't know if you've got anything to add on that.
Yeah, and I'd say that's when you see these big sell-offs like that, remember that companies in inflationary times can put prices up. So as put up in that slide beforehand, when inflation and interest rates go up, the asset classes long-term that do well tend to be shares and real estate and houses. So right now you've seen the initial cost shock and supply side shock and COVID problems and war supply problems, all of those things adding up. So it's perfectly normal and understandable that the markets would be very concerned about that in the short term. But long term, short-term markets are a voting machine, right? They trade on emotions and short-term facts. Long-term, they're a weighing machine. Logic prevails over time. So let's wait and see. But if history is anything to go by, if we have inflation for a little while longer here, it actually won't be too bad at all for the share markets.
Great. A couple of questions from Facebook. When will Ruffin Investments be divested? We didn't have very many, but those that we had were in the bond market. We have been trying to get rid of those through Vanguard, been trying to get rid of those. And my understanding is that as at the end of March, they had gone. But I've been trying to get confirmation of that. We haven't had the holdings report out from Vanguard yet, but we basically got out of everything we had. Another one from Facebook. In the future, will you be thinking about offering reverse mortgages just in case this drop lasts for a long time?
Reverse mortgages, yeah, look, it's an intriguing product. I think it's a really horribly sold product in New Zealand because reverse mortgages are very familiar overseas, but the ones here, in my personal opinion, are far too expensive. The people offering reverse mortgages are making far too much money off retired New Zealanders. So it is a possibility. We've had a first look at it. We may well seriously consider it later on when we have more money to lend. It seems to me that it is a product that should be available to New Zealanders at a reasonable rate, and retirees should not have to, pay exorbitant rates to get a reverse mortgage. So yes, it's on the radar. Are we going to do it tomorrow? No. Does it have investment merit? Yes, it's a pretty reasonable investment product. Could it be useful for our members? Yeah, it could. So watch this space.
Great, thanks, Sam. Now, from Gillian on Facebook, it's quite an important question. If someone is retired and in the decumulation phase and making regular withdrawals, how much of a problem is this in this market, i.e. you're crystallizing your losses?
Yeah, look, it's an interesting one, isn't it? So I have a few thoughts that come here. First of all is most people who are retired, if you reach retirement age, statistically, the chances of you living much longer than you think are quite high. So if you've made it to 65, there's a very good chance that you'll be making it to your late 80s, early 90s. So your money has to last longer. That means that you would tend to want to have it in more like, conservative balance or growth funds that have some shares in them, rather than just sticking it in term deposits in the bank. However, there are some people who hate the thought of losing, even on paper, the idea of losing some money. So maybe they should have their money all in term deposits and just live on less. But for the vast majority of people, I wouldn't worry about it in the sense that you're going to be invested and living for a long time. The fact that you have to take out a little bit and crystallize these losses when the markets go down is just a fact of life, right? Unless you can afford not to and wait for the markets to recover, but who knows how long they'll take to recover. But if you are in a balanced fund and you're just taking a little bit, yes, but you're just crystallizing a small loss there, and you still need the money to live on, right? You need that weekly income. But if you leave the vast majority of your money in there, then when the markets return, then you'll benefit. And remember that you'll get a higher rate of growth over the long term than you will have by having it in the bank. So in theory, for the vast majority of people, you should still be better off financially by being in any provider's balanced fund and withdrawing a little bit over time and being patient rather than pulling it all out, crystallizing the loss, sticking in bank deposits. That feels comfortable because you feel, oh, I've got my nest egg, it's not going to go down in value, but it really will, because remember that inflation will eat into those returns over time, and you will only get a low term deposit rate in terms of income. So it may give you short-term peace of mind, but long-term that can be a very expensive investment strategy.
As we say all the time, of course, we can't give you personal advice. So best thing to do is go to a financial planner if you really want somebody that is able to do that. Question on the chat: How much would a wealth tax, such as the one proposed by the Greens, influence my simplicity investments? Do you have any contingency plans?
We don't have a contingency plan for a wealth tax because we think it's extremely unlikely to happen in New Zealand for a little while. And here's why. 76 to 78% of New Zealanders' wealth is in their house, is in homes. So unless a political party wants to tax residential home ownership, and that's nearly all of that's first home ownership, a wealth tax is really not going to have a massive influence on investment strategies over the long term. And it tends not to have a big impact on investment strategies in those countries that have wealth taxes, because what they try and do is they try and tax all of the investments pretty much the same. So you add them up at the end and you do sometimes they're called death taxes, or there's a whole bunch of names for them. So no, we haven't made any contingency plans for that because we don't think it is likely to happen. And certainly when it happens, it's unlikely to happen in the thing that New Zealanders own most of, which is their own home.
Great, thanks. Claire's asked, how about lending to those who have relationship splits and have to start all over?
Well, that would be in the business of personal lending, yeah. Or
I think we're talking about mortgages.
Mortgages. Well, if you have a relationship split and then you are buying your own first home, I guess you would be eligible for a first home loan. But I'm unfamiliar with the circumstances. I'm sorry, I apologise. Our customer services team know all of this, but I don't. About whether or not you would be eligible if you had jointly bought a first home beforehand.
Yeah. Sorry, Sam, but no, you're not. If you've had an interest in a property, you're not. So it would require a change. I mean, yeah, we're thinking about something we could consider.
Maybe, yeah.
Another question from Chris. Is Simplicity using investor funds to become a property developer? Have you ring-fenced our investments in case your developments go pear-shaped, as many other developers have?
Sure. No, that's a very fair question. Of course, this has been looked at very thoroughly by all of the people involved, and we've spent a very long period of time making sure this is comfortable. First of all, the answer is yes, in the sense that what Simplicity will be doing is developing, owning and renting properties, which is very typical. So in that sense, we are a property developer and owner and renter over time, something that pension funds all over the world do. How do we de-risk this? Well, in several ways. First of all, as the first two developments, we're buying what we call turnkey. So we're not actually taking development risk. We're just buying them from NZ Living, who will then become Simplicity Living at a set fixed cost, funded by the owners of NZ Living. So the first 180 apartments will be buying turnkey. Secondly, if you look at the development risk that's involved in property developers generally, property development is a very risky business, but you can de-risk it significantly. And how we do that is this. If you think about the life cycle we go through from building to renting a home, first of all, is in purchasing land. We're a large-scale purchaser of land. We tend to get preferential terms and conditions. We have no financing fees. We have no set requirement for profit margins. We have no leasing fees. We have no real estate agent fees. All of these things get cut out. And the manufacturing or the building we are doing is very, very cost effective. To give you an example, the average price of building an apartment in Auckland right now would be something in the order of $4,500 per square metre. NZ Living is currently building, and we fully expect to be building at about $2,400 per square metre. Sheer economies of scale. There's a huge amount of margin there. which actually protects the investment. Secondly is we diversify them. We already have 6 different sites that we purchase, so there's diversification risk. And thirdly is the price at which we expect to rent these apartments will be lower than our other competitors in the market who have to do these things for profit and tend to have to pay a whole lot of phyllo pastry of fees all the way through. So is there risk? Yes, there is. Has that been very well thought about? Yes. Is this as de-risked as we can possibly get it? Yes, it is. But by the way, for that extra little risk you're taking, you will be receiving higher returns as well. The other thing I would say about this is, and Andrew, you may have the numbers to hand, the amount of money in any one of our funds going into this sort of housing development is actually quite small. It would be between, in some cases, there's no money at all involved in it, like in our default funds. The maximum, what would be the maximum asset allocation per fund? Would it be around?
Excuse me, 3% of the growth funds and 2% of the balance funds.
So when fully underway, the growth funds will have a maximum of 3% of the money that you've invested with us in these build-to-rent developments. And you know, so it's just part of a very diversified portfolio. In fact, I would also argue that it's de-risking the whole portfolio because it's further diversifying your investments. Yeah.
Great, thanks. Some more questions from Facebook, from Oliver. How long do you think infinite growth will continue in a world with finite resources?
That's a great long-term question. I'd love to sit and have a cup of coffee and talk to you about this, but I'll give you my short-term answer. There's not finite resources in the world. There's a massive amount of resources. You've just got to be prepared to find them or dig them up. There's no finite energy as well. Ultimately, there's a fusion reactor in the sun, which is pumping, well, for the next 140 million years anyway, will be providing us with more energy than we could possibly use. We just have to harness it and use it. So long term, I'm an optimist in this regard. I've lived through many arguments about the world running out of resources, and surprise, surprise, we find the resources. The carbon impact of that is the great challenge of our generation. We have to learn how to deal with that too, but I'm not an Armageddon scenario in that regard as well. I think technology and the sheer desire to solve the problems means that we ultimately will, but it's going to be a very tough and hard challenge, but we'll be up for it. That's my short answer. Let's say I'd love to have a cup of coffee with you and talk it through.
Thanks, Sam. Tom, are you looking at providing an S&P 500 fund at low cost in future, similar to your New Zealand share fund? It's unlikely, Tom. The reason that we have the share fund there really is as much as an investment for our funds, and there's no real reason why we would want to invest in a purely US share fund. So it's very unlikely we'd do US on its own. Sam, any further thought?
No, I agree.
Nathan, Facebook's asking, what will it take to open up home mortgages to all members, not just first home buyers? I mean, I think in essence that would mean the only reason we would be able to do that would be if we had many times more money than we have at the moment. Anything further, Sam?
Yeah, look, I'm hoping that over long term we can open it up selectively, and we had the suggestion there from maybe when someone has a marriage split and you're effectively becoming a first home buyer again, maybe in the future there. But we need to grow, so if you could just talk about us and we're growing a grassroots movement and get a lot bigger, we'll have more money to lend. Yeah.
Thanks. So Stacey's asking the difficult time for everybody that's got investments at the moment. I currently have a bunch of money split across 3 Simplicity accounts, Growth, Balanced and NZ Share, which have all been losing a lot of money. I want to use all this money to purchase a house later this year. What investment account type should I be using over the next 3 months so I have the best house deposit? So it's dreadful. I don't know. How do you want to answer this?
It's a very hard question because we don't know where financial markets will go. So they could go down even further. I would say, I'll give you some comfort there. If you use that to buy your first home, it is highly likely that house prices will go down as well, so that you might have some correlation there. You might be buying a cheaper house with less money. But it's been presuming these investments, if you've been saving for a long time, have done very well for you, over the long term. I know that our growth fund, for example, the last 6 years is still up very significantly over the last 5 years. So it's very, very hard to know. If you need to preserve all of your money right now and you cannot afford to take any risk, you might want to consider crystallizing the loss and taking it out and then hoping that house prices will go down. But if it was a good strategy for you beforehand, there's no particular reason why it shouldn't be a good strategy in the short, medium, or long term. But it's very, very hard to know. I'm sorry. It's because we just have no idea where financial markets will go. We never do. No one ever does.
Ian, it's a question for me, and I'm trying to think how to answer it. Dollar cost averaging. Any chance for contributions to be added daily instead of weekly in the future? I mean, you can set up an AP to put money in daily. We would certainly have no problem processing daily contributions. If you want me to go into any more detail, Ian, maybe send me an email directly. I'm just andrew.lance@simplicity.kiwi, because I'm not quite sure how to answer your question. Gillian is asking, do you have any timeframes on the possible new fund that you've talked about, Sam, that would be better than bank deposits for the retirees?
Sure. So this is an idea that we're thinking about. If we have a lot of homes where we're getting rental income, which is providing better than term deposit rates, and then we also do mortgages where we're getting better than term deposit rates from people who are first home buyers. If we have enough of that income, then could we take more money in, lend more money on mortgages, build more affordable rental homes, and then provide those returns to members? Look, I think realistically, we wouldn't look at that until we were getting rental income, and we expect to be renting our first long affordable homes long term from February of next year. So I think that's reasonably, that would be the earliest that you could reasonably expect us to do this. It also depends on how much money we could lend out on mortgages, of course, because we have the capacity. If we were to receive a whole lot of money into a fund like this, then we could lend that money out. And that could potentially, we could open up our mortgage lending to other home buyers, not just first home buyers. All of these things are possible, but realistically, we want to make sure that that fund is invested across a lot of different rental homes, a lot of different mortgages. So it's very diversified and very reliable in its income stream. So yeah, I think, what do you think, Andrew? I think realistically, it's going to be a sort of first half next year.
Oh, I think that might be a tad optimistic, actually. Yeah.
We'll see. Yeah, we'll see. But certainly, I'm very excited by the opportunity of offering particularly retired New Zealanders, but also actually for people who want to save for their first homes too, an investment which is secured by housing, but you physically own the homes that are being rented, and you're lending on the mortgages, and just first mortgages, low risk mortgage lending, to provide higher than bank income for people who've invested. Now, it won't be a capital guaranteed, it won't be a term deposit, it won't be, but the amount of money invested will go up and down with basically the value of the houses, and so up long term, but provide a very steady income on the way through.
Great. Kate, your question on the chat, hopefully we've answered, which is about if you've got a lump sum, are you better at drip feeding it, which is our view is correct.
Generally, it's not personal advice, so that may be better for you, but as a general rule, drip feeding it in is a good idea, yeah.
Question from Ian is, as a retiree now, we were recommended to change to the conservative fund, but it's collapsed and we've lost all the gains. We have to look at a more short-term focus due to our age. What do you think? Sure.
So first of all, you have not lost the money. You only lose the money if you take it out. It's gone down in theoretical value. All of that fixed interest that is in that fund will still repay all of the money that's been invested in it with the interest that it was paying when we bought it. So if you take all of your money out now, you'll certainly crystallize a loss, but do not feel as if the fact that it has gone down means that it will stay down forever. It could also go up, as it went up again as well. And when interest rates come down, the value of those fixed interest investments will go up. If you think about it like a tilt, interest rates go down, value of fixed interest go up. Interest rates go up, the value of fixed interest investments go down. So it's a theoretical loss in the first instance. So if you feel as if you have lost your money, it has lost its theoretical value if you took it all out today. Otherwise, you're going to get it all back with the interest that it was earning. Now, so that's on the fixed interest side. On the shares side, if it's in the conservative fund, about 20% of the investment is in shares. Those go up and down with the market. As you saw, it's a roller coaster, but it trends up over the long term. So unless you need all of that money now, right now, to spend right now on something, you may well just consider just riding it, just letting it ride, letting time be your friend. Remember, you have a huge competitive advantage if you're investing over the long term, because the long-term trend is the markets go up. So I would just caution you about thinking that you've lost the money and that you need to now put into short-term investments. You have just lost it theoretically. You've only really lost it unless you take it out right now.
Thanks, Sam. Just to rattle through some more of these. Given New Zealand's rosy outlook, do you have a fund where we can invest primarily or entirely in New Zealand?
We don't. So in our growth fund, we have a lot of New Zealand shares, and we have a lot of investment in startup New Zealand companies, which is we are now invested in about 62 New Zealand startups. We've committed $100 million to do that, which is about all you need to do, because not many of these companies need very much money. And that would be mostly in our growth fund. You'll be pretty exposed to New Zealand shares and New Zealand high growth companies. And then in our conservative fund, an awful lot of the investments are in New Zealand bonds as well. So no, we don't have a completely NZ Inc. fund. We might have one in the future, but right now we think, the majority of New Zealanders have most of their wealth in New Zealand. As long as we're investing a reasonable amount in there, that's good. It's part of a diversified series of investments. And bearing in mind also that when it comes to things like affordable housing and so on, and first mortgages, we're doing as much as we can with the money available to us without taking unnecessary or undue risks for our members. We just want to make you more money over the long term. This is another way of sensibly doing it. Yeah.
Yeah, I mean, of course, we do have the New Zealand Share Fund, but we generally see that as being a little bit too concentrated, really.
Yeah, because how many companies are in that, Andrew?
About 40.
40, okay. Yeah.
Michael says, won't most KiwiSaver funds be invested offshore, mainly helping offshore businesses?
Yeah, well, that's one of the sad things about the investment environment in New Zealand is the stock market here is very small. There's not many other things to invest in that the councils or the government make available to local investors. So yeah, around about of every new dollar coming to KiwiSaver, I'm guessing about 70 cents would go overseas, 30 cents would stay in New Zealand. And that's got an awful lot to do with the lack of investment opportunities in New Zealand. It's one of the interesting areas why we're getting into affordable housing and mortgage lending as well. It allows us to invest more money in our local market and benefit New Zealanders and benefit members. But it's a challenge being in what is effectively a relatively small country, but with a very small capital market. Yeah.
Question from Seaton. Are there any plans to introduce a product with more risk, like 100% shares?
Yeah, we get asked about this, about having an aggressive fund, and that's also on our radar as well. So we have this, income fund, which is backed by property investments, and then at the other end, we also have this aggressive fund. So it's on our radar. We are actively thinking about it. Yeah.
Neil's asking, he's currently in a balanced fund looking to purchase his first house this year. Should he switch to a conservative fund? Neil, we are not able to give you advice on these things, I'm afraid. Sam, is there any broad brush comment you want to make?
No, look, I think it's because it's very hard to know where the market directions are right now. Bearing in mind that, of course, if you switch from a balanced to conservative fund, you're actually switching out of shares and more into fixed interest. You are, in a sense, crystallizing some of those losses there. So if a balanced fund was fine for you 6 months ago because you're buying a house, it may still well be the right product to be in right now. Very, very hard to know over a short time frame like that. And we don't pretend to know. It's a very random journey over the short term. Over the long term, that financial markets go up.
Question from Janet, which I'm not sure is a question. One World Bank digital currency cyber attack, all the money in the one bank will be lost. I think essentially, Janet, our view is that, as we've said, we diversify as much as we possibly can so that we don't have anything in one entity. And therefore we can't lose everything in one go.
And in that sense, the World Bank is not a bank, it's a development agency, and it has very small amounts of money relative to the rest of the world, tiny amounts.
Yeah, if we're talking about the World Bank, that one doesn't have any digital currency anyway. Joseph on Facebook, why is the Conservative Fund providing -6.5 when growth is only -3 in this volatile situation? I imagine that is. Yeah, Sam, you go.
Well, you've had the Conservative Fund has a lot of long-term government bonds. Now, remember, with those bonds, they're investment grade, and the money will be repaid with the interest. But in the short term, because interest rates have gone up, the value of those bonds, the theoretical value of them, if you had to sell them all today, has gone down. And the reason that they've gone down is because if you bought a government bond that pays, say, 2% interest, and you're holding that, and then suddenly the government offers another bond where it pays 5% interest. Well, of course, anyone who's buying would buy the one paying 5% interest right now, which is the case because interest rates have gone up, right? So the theoretical value of that government bond paying 2% has gone down. But remember that government bond will get repaid and you will get your 2% interest over time. So that's why, in theory, it's gone down in value. In practice, though, that only happens if you sell those investments right now. And the longer term bond, the more the swing is. And we have a lot of long-term bonds because investment theory and logic and, in fact, investment practice tells you that you make more money over the long term if you buy long-term debt from the government rather than short-term debt from the government. The downside is that when financial markets when interest rates go up, their value goes down more. So think about this as, say, 1 year, 3 year, 5 year, 7 year, 10 year. The more interest rates go up, you lose more. In theory, I cannot emphasize that enough. Those bonds are still going to get repaid by the government as they always were, and you will get the money back.
Okay, so question here from, you just got to scroll up slightly, from Vanessa, asking about the Vanguard funds that we invest in, and the fact that New Zealand investors, particularly those in growth funds, would not be able to claim the 15% tax credit on this proportion of their investment. This would have an impact on the fee structure. Vanessa, in terms of fees, that's not correct, because we don't actually pay within our diversified funds. We don't pay very much money to Vanguard at all in the funds. I'm just wondering whether we're talking about tax there rather than fees.
Yes, I think probably what you're talking about, Vanessa, is that what they call the imputation credits on tax. And so there are a handful of funds in New Zealand that are domiciled in New Zealand. They're called New Zealand PI, which means they get the benefit of those imputation credits. We're very actively looking at doing that ourselves now so that members end up getting effectively higher returns. But up until now, it hasn't been economic for us to do that. You need big economies of scale to be able to do that. But as I say, we're actively looking at that right now. So I think that's what you are talking about. So there is a performance drag in theory, but in practice, you've got to get to be large enough now. We have about $1.8 billion now in overseas shares spread across our funds. That's getting to the scale now where we can seriously think about onshoring that and then passing through some imputation tax credits to our members. It's a pretty esoteric subject. Happy to talk about it offline, but that's the net effect of what we're trying to do.
Great. Elizabeth asks, given your increasing commitment to the housing market, would you go as far as to invest in associated industries such as jib production? Is that
Sure. Well, funnily enough, we already own about 0.8% of Fletcher Building, I think, in our funds. And so we are already invested in the building industry in that sense through our share ownership of Fletcher Building. Although I would say that, so with our shareholder lever on, that's okay, except that we don't particularly like the way that Fletcher Building runs the jib market in New Zealand. And so as a consumer, Simplicity Living, we're also actively looking at options that don't involve jib as well. So, we have sort of several hats on right now, but short answer to your question is yes, we are already invested in the building industry. Yeah.
Great. Then question from Jake. What are your thoughts on Cathy Wood's investment strategy and her ARC investment fund?
Well, yeah.
You know that one.
So, well, if you want to go on a roller coaster, if you want to go on a supercharged roller coaster, one with boosters all the way up and all the way down, then Cathy Woods would have been great. So I don't know if you've seen, but if you have a look at like the normal markets like this, her ARC fund goes up and it's come all the way back down now and it's below it. So no, we're not a big bet of highly concentrated active management in the way she did it. She had a day in the sun, but Andrew, you and I have been doing this for decades now. I've been investing for 45 years now. And look, I've just seen these superstars come and go. She's just the latest one. And sure enough, it turns out she's been a bit of a supernova. Looks like she's now making people less than had they been invested in her a long time ago.
Another question about dollar cost averaging into the growth fund. Sam, on balance, our view is that drip feeding over time is the better way to do it, but we can't give you advice. So that's just our.
It's the awesome thing about KiwiSaver, right? You know, KiwiSaver investments being 3% of your income means they're inflation adjusted. You're always saving 3% of your income. And in times like this now, you should be happy. Like I'm actually almost, I mean, I'm not happy that people feel as if they've lost money because they've lost theoretical value, but I do love it that the vast majority of our members are currently buying investments on sale over the long term. That's what that is the net effect of what will happen, even though it doesn't feel like that right now. So when markets go down, it is an opportunity for the vast majority of our members to get richer, not poorer.
Great. Question here from Kevin. Would you consider moving into the retirement village business? And do you have comments on the current model, particularly deferred fees?
Yeah, look, the retirement village model is highly profitable in the way it operates, and there's some very competent operators making a lot of money there. If simplicity living got to be big enough, I'm not sure that we would get the retire. I mean, you can never say never, right? Maybe, but certainly what we would be doing is offering long-term affordable rentals. That's an option to being in retirement homes. So you could sell your home and basically rent for the rest of your life and keep your nest egg to do other things with rather than having to buy a retirement home. So is it an option? Yes. Is it one we're actively looking at? No, we're walking here. We're walking to success. We're not running towards it, and we will learn as we go. So as I say never. Certainly it will be another option for people from the get-go to rent long-term. And wouldn't that be wonderful? Yeah.
Thank you. I'm comfortable with the current situation with Simplicity, so I'm continuing to put 10% into my KiwiSaver account. How does performance by Simplicity compare to other major funds?
Well, it depends. So short-term, we have a lot of those long-term government bonds, which we know long-term will work for investors, but you can go through a short-term period of underperformance. So I think that our funds in the short-term have underperformed most of our competitors. Long-term, though, we're very, in fact, I think we're always in we're a 5-year performance, we're in the top 5 of about between 30 or 40 competitors. So pretty consistently in the top 10 or 15%. We don't really worry about short-term. Short-term is just people get obsessed with that, but that's just for marketing purposes. So your long-term returns to you that matter. So the answer is doing very well. And of course, bear in mind that we will have lower fees. We have if you go onto the sort of website, you'll see we have the lowest conservative fund fee, the lowest growth fund fee, balanced fund. I think we're third because anyway, there's some interesting behavior by some of our competitors, but I won't go into that. But so with consistently very, very low fees, and ultimately that's what matters. If you're earning, say, 5%, say every finger is 1% of a fund. If you're paying a 1% fee, you're actually losing 20% of your investments every year of going to your fund manager, right? That's like a tax, right? 20% rather than a fee. That will think of this way. If a fund manager said to you, KiwiSaver manager said, for every $5 you make, I'll take $1 in fees. You wouldn't like that, would you? Well, that's actually effectively what 1% is if your fund's making a 5% return. So if by charging the lowest fees, that's how you win long term, and that seems to be what's happening.
Thanks. Bit of a repetitive question, but Stacey, you're asking again, what's the best investment strategy for a sort of 3-month view? If you're really are looking that short term, then really, I'm afraid the bank is probably about the only place you can go.
So you have a 3-month view, stick it in the bank, because who knows what will happen over the 3 months. For pretty much everyone else, your 3-month view should be your 10-year view, right? KiwiSaver savers and so on should have a long-term view, stick to it, benefit from dollar cost averaging and so on. But if you need to make money in the next 3 months, we have no idea. Just put it in the bank. I honestly have no idea where financial markets will go in the next 3 months.
Question from Claire: are the funds for building residentials coming out of the KiwiSaver fund, or separately? I presume you find investors for these builds.
Yeah, so we have the money being funded out of our KiwiSaver and investment growth and balance funds. It's a very small percentage, 2 or 3%. Remember, we haven't even spent that money. That's the theoretical amount that we could lend. We're just starting. So it's a tiny amount of money in those funds right now, but it aims to be no more than 2 or 3% in those funds. And as it becomes more successful, it may go up higher than that, but it will go up slowly. To give you an idea, in a place like Germany, a pension fund when they've been doing this for centuries, they may have maybe 10 to 15, maximum 20% of their money would be in this. But remember, that's diversified over thousands of homes in many different cities with very reliable income. And it tends to become a substitute for fixed interest for putting money in the bank. But that takes a long time, and we're just going to do this slowly and properly and get it right. Yeah.
Question from somebody is: where are the other Simplicity housing sites? Do you want to?
Yeah, so we have 6 sites. We have 2 in Point England, 1 in Mount Albert, 1 in Mount Wellington. In fact, we have 2, 4, 5, 6, and 2 in a place called Owaraka, which is effectively Mount Albert. So we do them in what we call the Isthmus of Auckland, the inner city Isthmus. So no further west, well, at the moment, we're just looking at the moment, but our target is no further west than New Lynn, no further south than Mangere, no further north than Albany, and just looking for really high quality sites, very close to public transport, very close to supermarket, very close to public facilities like pools and so on and so forth, ideally within walking or cycling distance of both of those. Over time, we think that because we're a patient buyer, because we're a cash buyer, we think that we will be in a very strong position, and the sites we've got so far are fantastic.
Thanks. Question here: if I'm looking to invest with my children, what is your recommendation, KiwiSaver or the investment funds, noting that KiwiSaver is less flexible when it comes to taking my money out?
Yeah, well, if your children are under 18, with Simplicity, it makes no difference at all, because the same investment fund and KiwiSaver have the same investments, they charge the same fees, but as you say, you have access to the money. If over 18, KiwiSaver is very attractive because the government gives you that, $1 for every $2 you invest up to $521 of subsidy a year. So it's free money after 18. But up until 18, it doesn't really matter, to be honest with you. You could go into either, and if you want the flexibility to access the money, that's fantastic.
Great. A question from Caroline: how does buying land, an empty section, compare with dollars invested in the share market, i.e. for the capital gain? I'm thinking of buying in a location where prices are still lower compared with other places, but likely to increase.
It's hard to know going forward. You can't predict it, and past performance is no indication of future performance when you compare asset classes like land and shares. Look, I would say this: my personal piece of advice to anyone who comes to me, young person, says, where do I put my money? One of the first things I say is buy a house or land as soon as you can and pay it off as fast as you can. The reason being that real estate generally is a tax-free capital gain. And so you have that advantage. They're not making more of it, of course, and you need a place to live, right? So there's a very real emotional and human reason why you'd want to own your own home. That said, as soon as one asset class return gets wildly better than another, tends to level out over time, right? So hard to know how they would compare against each other over the long term. I would actually, personally, my advice would be, what do you want Do you want that piece of land, or do you want to live in your own home more than you want a pile of investments? Because I think both of them will be perfectly fine over time.
Somebody asking here, why can't you extend the investment funds to non-New Zealanders? I'm trying to remember why they are generally limited to New Zealanders. Part of it is that we have to check everybody for the whole anti-money laundering regulations and counter-financing for terrorism. And it's much easier for us to do that using New Zealand systems. But I will have to check on that one. Sam, do you know any?
No, I think that's the principal reason. It's very, very difficult to know, and very, very difficult to guarantee from New Zealand that a non-New Zealand investor satisfies the anti-money laundering and counter-financing of terrorism requirements overseas.
Don't know quite how we're going to answer this one, but how much are you focusing on environmental startups and environmental companies?
Yeah, quite. I mean, in the sense that if you have a look at the startup companies we've invested in, a whole bunch of them are environmentally focused. That doesn't mean that because they're an environmental company per se, they get any special treatment, although inherently the chances of them being a successful business are high now because they are environmentally conscious and aware. And equally also, of course, we're going to have to report on the carbon footprint of all of our investments in a few years' time. So that's going to be it's going to have a huge impact on corporate behavior in terms of them becoming environmentally conscious and investing in all of these new technologies. So it's kind of happening anyway. Obviously, Simplicity as a long-term investor thinks massively about the environment. We've planted 122,000 native trees in the last 5 years. We plant one for every member. We want to make our affordable homes carbon neutral. In fact, arguably carbon positive if we do what we'd like to do there. So we care a lot about it. We invest in a lot of it because that's a smart thing to invest in, but we don't massively skew pro-environment or anti-environment. Well, bear in mind, of course, we have all of these exclusions, right? So we don't invest in fossil fuel companies, for example. So, I guess, sorry, as I've been answering this question, I guess we sort of do. It's just that we kind of feel it just feels like normal business to us. It's just a sensible thing to do, but I guess net that is actually what we're doing,
yeah. Question from Fiona. I'm retired and have some savings in balance and something conservative. I will use the balance monies in 5 or 6 years. Should I keep saving in balance for the next 3 or 4 years?
I would go to the Sorted website and have a look at the fund finder, find out what funds are right for you, for your circumstances, and just have a very long-term view on it. Yeah. So, and it depends. I can't give you personal advice. It depends very much on what your demands are for money and so on. But I would not be overly concerned by what you have seen short-term in the markets. We don't know which way they will go long-term. We know what the market directions are. And bearing in mind also that if you're retired, you're likely to live longer than you think you will. So, your money is likely to have to last longer than it did in the past because you're likely to live longer than you would have in the past.
Interesting question here from Michael. The graph for US shares showed a period that was flat from the Great Depression through to about the 70s. It was hard to tell from the scale. It suggests markets can sometimes provide no growth for 30 years. Why is now different?
It might not be different. It might be true that there's no market growth for 30 years. We just don't know. I would say the odds of that happening are quite low because technology is a massive game changer, and that doesn't seem to be slowing down. Secondly, you have reserve banks and central banks around the world that are much more adept at taming inflation than they were back in that period of the Great Recession, I think you're talking about, which is in the 70s and 80s and 90s when really inflation was out of control and no one knew how to get it under control. And there was oil wars and all that other stuff going on as well, very destabilizing Cold War conditions. Could it happen again? Yes, it could. Are the odds are that we actually learn a little bit more, and that these periods of volatility get less over time, not greater over time. But I don't know. But what I do know is the vast majority of our members are saving for a very long period of time. And in fact, if you have a look at even a 50-year-old who starts saving now is likely to live until their 80s, in which case they've got an over 30-year period, in which case they would be buying, even if it went down all the time, they'd be buying more. And then when it goes back up again, that would have been a fantastic investment strategy. And that's even someone starting at 50, let alone someone starting at 20 or 30, saving money. So it's very, very difficult to know. Your best friend in the uncertainty is diversified investments, pay the lowest fees. That's the winning strategy.
So another long-term one here, Sam, from Fiona. Good to hear that you're upbeat about markets for the 30 years ahead. How will catastrophic climate change impact this? Is it possible to have BAU with market growth likely to continue as we face the sixth mass extinction and global disruptions from climate instability, economic shocks, economic refugees, etc., over that 30-year horizon?
Sure. So look, this is another cup of coffee question because it's a very massive question. First of all, I was very optimistic about New Zealand in the next 30 years, not necessarily the world. I don't know what will happen in the world. I'm not that smart, but I do know that New Zealand, if history will repeat itself, will go from being a capital poor to capital rich country. You talk about climate change, and I think it's the grand challenge of this generation and maybe the next generation as well. Doesn't mean that it is game over, that the world is going to end, that we have completely lost control of it. I personally don't believe that because I've lived through a life where nuclear war was going to kill us all, where we're all going to run out of resources, where inflation was going to run rampant, destroy us all. And every single time, it's why I put that Mark Twain phrase up, the thing that really gets you into trouble is the thing that you know for absolute certain. So if you know for absolute certain that the world is going to go through massive catastrophic climate change and the world's going to end, well, in that case, the world's going to end. No investments are worth anything, right? So it doesn't matter what we do if the world's going to end because of climate change. But if we're going to go through a period of catastrophic change as a consequence of the climate, then you either believe in the ability of humans to adapt to that environment and get it right and get it better, or you don't. And if you don't, it's probably not much point investing in anything other than a piece of land in Montana and growing vegetables. But if you do a piece of land in New Zealand maybe and growing vegetables, because we'll be one of the countries least affected by climate change, apparently. But I'm more of an optimist than that. I think that we are now, the first step to solving the problem is acknowledging the problem. And we are now finally acknowledging the sheer scale of what we have to take on here. Do I believe that we can take it on and succeed? Well, tens of thousands of years of human progress shows that we're actually pretty adaptable to the environment we're in. And I believe that we will come to terms with it, not without a lot of bumps along the way for sure. But I'm fundamentally an optimist about that.
Thanks, Sam. I realise some of these questions are from an hour ago, so I'm hoping that people are still listening. Possibly not. John asked, does my balanced simplicity fund include bonds? John, yes, it does. About 20% of your fund is in New Zealand bonds, and about roughly 20% is in international bonds as well. Joseph's asking, moving from a passive investor to building houses could mean a distraction. How does it align with our low-cost passive model?
Yeah, so that's a very good question. So it certainly is low cost because we're building these houses at a fully completed home on average will be $450,000 is what it will cost us to do. That is well below the market price for homes. Even KiwiBuild prices are much higher than that. So that's the low cost aspect of it. It certainly fits in with our fee structure. We're able to afford it by charging the same fees that we do right now. That's just because it's the way we do things. In terms of a passive model, it's also very passive. Remember that a passive investment is not just passive listed investments. You can be a long-term owner of thousands of homes all around the country and be a passive investor in residential real estate, which is exactly what we intend to do. So the passiveness of it hasn't changed. The low cost aspect of it hasn't changed. And in fact, what it further does is it further diversifies our portfolios and it increases the returns in the long term. It's a complete win long term. as has been shown all over the world, which is why pension funds like ours invest in this asset class and very large amounts in this asset class over the very long term. So that's how we make it low cost and passive, because it is low cost and passive. Yeah.
Question from Brett: is it possible to estimate the effect of climate change on future investment earnings? I mean, essentially, no. There's a whole load of reporting which is about to start as of, well, a year and a half away. Brett saying exactly how much carbon we're emitting in our portfolios and in our business and so on. But actually, the effect on future investment earnings, I think, would be quite difficult.
And by the way, that thing that Andrew just said, that's one of the reasons I'm massively long-term positive about our ability to handle climate change. Because once there is the transparency and there is sunlight of the carbon emissions of every company in the world, listed company in the stock exchange, there's going to be massive incentive for those companies to get that number down, because that will affect whether or not we will invest in them long term, and people like us as well. So, often sunlight is the best disinfectant. There's going to be a massive amount of sunlight on carbon emissions from companies, and that is ultimately a big positive.
Question, sorry. My investment goal is to build a large enough portfolio so I can live on the dividends without ever touching the principal. Would simplicity ever allow members to take out distributions rather than selling down the fund?
Well, effectively, that's the same thing. What we do is we get all of the capital gains and all of the dividends, and it comes up to the unit price, and you can just sell a certain number of units, which would, we can give you the approximate dividend yield on the portfolio. So you're only taking out what is effectively the dividend. So you're effectively achieving the same thing. We're also going to bring out some cool new tools pretty soon, which will show you how long your money should last, depending on how much you want to draw down on it as well, which would be cool as well.
Question from Anne. We want to transfer our conservative KiwiSaver fund with you to a balanced fund. Should we be drip feeding this transfer? Is it a good time, or should we wait? I'm afraid, Anne, we can't give you any advice. And one other restriction for us in KiwiSaver is that we only allow anybody to have one KiwiSaver fund. So you can't split your fund between conservative and balanced. So I'm afraid with us, you'd need to do it all in one go. As to when is a good time, as we've said many times, we really don't know.
But if you can only do one transaction, then, from conservative to balanced all at once, it's probably best to go to something like the Sorted Fund Finder or Money Hub. Find out what fund is right for you right now, and if case, then make that change. Sure. And not try and second guess which direction financial markets are going in, as long as you have a long-term view. So as I say, I hope all these people are still listening. How do you see current escalating geopolitical threats and instabilities impacting on market growth generally? Can markets grow when underpinnings, political and international trade systems appear to be so broken and getting worse? I have absolutely no idea, and never will. And I would make one observation. In my entire investment life, almost, 45 years worth, it has always been, there's always been someone saying the world's about to end. There's always been someone saying it's all wrong. And it hasn't proven to be the case. And I don't think it will be in the future. I don't think it can be all wrong for very long, just like I don't think it can be all right for very long. It's inevitably balanced, as inevitably good and bad. But fundamentally, if human beings want to get up and create a better life for their children and their grandchildren, and work hard and set up businesses and so on, and be conscious of the environment and want a greener world for people to live in, and so on, that fundamentally, for the majority of people, things continue to get better over time, not worse.
Have you changed your views on crypto yet? What is your view on some KiwiSaver providers that provide crypto exposure to their customers?
Well, look, I don't mind some of my competitors gambling with their members' money by investing in crypto. In fact, it's not even gambling, because even gambling is regulated and taxed. So no, my view hasn't changed on crypto. Look, people can invest in crypto if they want to. It's their money. They can do what they want to. But we are not going to invest in it until it is regulated and until it is taxed, like every other investment we have, because that ultimately means when something goes wrong, we can go to the regulator or the government and try and get redress. But right now, if someone stole all the crypto or the vault went bust or whatever, there's no redress to anybody. There's no sheriff to go to. to say something's gone wrong here. The underlying technology in crypto I'm very happy about. Blockchain is fantastic. We use it in our business as well, but the manifestation of it in cryptocurrency, look, that's just, I mean, I have no idea what it will do. I think about cryptocurrencies pretty much like Beanie Babies, or anything that anyone ever releases saying this is an investment opportunity without you having any opportunity to actually get your money back if you get ripped off. So, and I don't like the fact that cryptocurrency uses so much power, and I don't like it that it's used to launder so much black money all around the world, drug money all around the world, all of those things I don't like. But fundamentally, the reason we don't invest in it and won't invest in it is because it's unregulated and untaxed, and we don't put members' money into investments where there's no regulator and where there's nowhere to go if it goes wrong, or no one to turn to make redress if it goes wrong.
Yeah. Question from Danny: how do you see the handing over of significant sums of inheritance from the baby boomer generation to their offspring impacting markets and investment?
It's a good question. I think what it will do is it will funnily enough, it means that people will be selling houses and giving it to kids and grandkids. So a bunch of that may end up back in houses in terms of house deposits for the next generation. A bunch of it may end up in other investments as well. So as a general rule, I think it is having all of that wealth sitting in the hands of an elderly population, particularly in houses that are unproductive, is generally not good for growth. So that demographic bubble may actually slow down growth over the long term a little bit, as it has in places like Japan and arguably Korea and arguably now China. But, you can see plenty of blips along the way there. But fundamentally, I think that means that, think about it this way, right? In New Zealand, in 50 years' time, our population could well start shrinking. Well, when that happens, that changes the dynamics of everything, right? Because everyone's got old, and then suddenly, it may be that owning a home on the outskirts of Auckland is not such a great place to be. Maybe you should own in the central city, or who knows what will happen with those big demographic shifts. So the answer is I don't know, but history tells you that it's a slight dampener on growth, but only a slight one over time.
How are we responding to this is a question from Tim. How are we responding to the competition lowering fees, e.g. Kernel's KiwiSaver at 0.25?
Well, we're going to carry on doing what we're doing. So, which is, charging a very low fee across all funds. And so I think there's always going to be someone who has a business model that focuses on low fees, but is a for-profit model and ultimately will be challenged by the claim they make. So let's wait and see. Certainly, we've lowered our fees 4 times in 5 years. As we get more and more scale, we'll carry on lowering it. It's part of our business model. Let's see. There's always been, in the last 3 or 4 years, there's always been one person in the market that has theoretically lower fees in some funds than us. So far, none of them have survived in that regard. Well, in the sense that in some cases they've had to put their fees up, in some cases we put our fees down and we're now lower than them. I know that we have an incredibly enduring business model that fundamentally wants fees to be lower. We have some other low fee for-profit competitors who fundamentally want to make their shareholders more money. So I know that our in theory win in the long term, even though in the short term you can always point to a fund or somebody doing a little something a little cheaper right now. To be honest with you, I don't pay too much attention to what our competitors are doing. Andrew, we just want to make our members more money, right?
Yeah.
Yes. Yeah.
So, interesting question here. Why is the media not more interested in the positive simplicity story, including the housing initiative? Is there anything that can be done to increase media coverage?
Well, it's a good question, because we always get told about how much media coverage we have, not how little. But look, I think over time it will become aware. We tend to do less talking and more walking. So we know that we have a very enduring model. We have 123,000 members now who are our members. Remember, we just started around my kitchen table 6 years ago with nothing, right, Andrew? So there was literally nothing. So we're still growing very fast. We don't spend a lot of money on marketing and advertising because that's our members' money. So we're very frugal with how we spend it. So I guess if we wanted to, we could have got a lot more paid marketing of what we're doing in the housing market. But I think people will find out over time. When more and more people move in and realize, wow, this is really good value. I've got a warm, safe, dry home for the rest of my life if I want it. They're going to tell people and they're going to tell people and it will become obvious. So I'd much rather earn trust than buy it, and earn goodwill and earn, and members talking about us is the best thing, but you've got to prove it, you've got to do it. And that just takes time, and that's fine. We've got time. Time is our competitive advantage, just like it is yours as an investor.
Great. Interesting question again from this time from Dara. Why not harness the sun's energy in the homes you're building with solar power?
We are looking at that. Yeah.
Nathan asks, what other products are on the wish list if Simplicity have more members and funds?
Well, I think we've already identified the two of them. One will be an aggressive fund, which was all shares. We want to get the tax of our international shares 100% right first before we do that. We're working on that right now. The other one would be an income fund for retirees, first home buyers. Interestingly enough, also I think that would really appeal to first home buyers because it would be invested ultimately in property. With the affordable rentals, and as the value of those affordable rentals went up, it's kind of like a way of linking your savings to the value of homes before you get to buy your own one. I think those two are the most interesting ones because they're both scalable. They could change the lives of a lot of New Zealanders or the wealth of a lot of New Zealanders. We could do a tremendous amount of good. So we only really want to participate in things that where they really do make a big difference to a lot of people over time. And those are the two obvious ones. Maybe reverse mortgages as well.
Great. Now, Chris, you've asked another question here, and you've actually said perhaps it's better to discuss offline. That's a good idea. If you want to, again, flick me an email, my email address is andrew.lance@simplicity.kiwi. We can maybe talk you through that then. Question here, if one were to transfer investment fund into the KiwiSaver fund, the same fund type, what are the steps? Probably simplest there to ask our customer services team with that question. If you just send a note to info@simplicity.kiwi, and the team there will be able to answer. We don't offer an international bond fund only, no. And are we planning to? No. Again, the reason for the New Zealand Bond Fund is not really because we particularly wanted to run a New Zealand Bond Fund, but it was just an efficient way for us to manage our own, the bonds that are owned by our Simplicity, KiwiSaver and investment funds. And so having an international bonds in there as well, from our point of view, there isn't any real reason for doing that. There are very good international bond funds out there already. Dara notes that we don't rate as well as we should on the Mindful Money website. Are we planning to address the less ethical investments we have?
Yeah, look, it was one of my bugbears here because I think Mindful Money are not fairly representing us in this one. First of all, I think it is on animal testing, which is the one where we fall down versus some of our competitors, although that's a very interesting asset class. How you, not many products are not tested on animals one way or another, but I get that there's a cutoff point there. But what we don't get recognition for is all of the stuff we're doing, for example, with affordable housing, investing in community housing, the shareholder advocacy we do. We would probably be one of, if not we're certainly one of the strongest advocates for all of the things that the typical Mindful Money users would be interested in. Gender diversity on boards and corporate governance, CEO and fair pay, sustainability, all those things. So we're having some conversations with Mindful Money because I think they need to improve the way that they rate these funds. They typically have just been involved on what are you excluding. It is not what you don't do, it's also what you do that matters in terms of making a difference. But I appreciate that if you look at it right now and you put in those criteria, we don't rank as high as some people, although we still rank pretty well.
Question here from Sandy is how about 10-year view and planning towards retirement with time being a little more limited now? I'm still working on high growth and happy to keep doing so, but would be keen to know if there are any other thoughts. Of course, knowing you can't give advice. I mean, I think we've probably covered that a couple of times already, have we?
Yeah, I think so. You're talking about basically investing and being happy in retirement?
Well, yeah. Do you stick with growth?
Diversify, pay the lowest fees. Don't sweat about the markets because they're only theoretical losses and gains, and just take a regular income. And, you know, I mean, and don't worry about it too much. I mean, as long as you've got those basic settings right, you should be, you know, fundamentally as well as you could be. A lot of people expend a lot of emotional energy on whether investments are going up or down and worrying about it, which actually detracts from the whole point of money in the first place, which is that you should be getting yourself into a happy state of mind, right? So as Warren Buffett would say, he says, I'm almost negligent with my investments. I don't look at them very often. And I think that's, if you get the settings right and the basics right, and, you know, you look at them, you know, I mean, if I was retired, maybe I'd look at them a couple of times a year, 3 times a year, something like that. And because, you know, you don't want your investment strategy to be worrying, to keep you awake at night. That somewhat seems to me to defeat the point of having money in the first place, is if we end up dying of stress. You know what I mean? That's yeah. So I just get those basics right and then stick to it and feel comfortable that you've done fundamentally the right thing.
Great. Couple of questions here from Jenny. Why and by whom has it been decided that our largest investment is in Fisher & Paykel Healthcare? Their future performance appears to be bleak, according to one analyst at least. And then why are there so many investments in bonds in various minor countries scattered around the world? Isn't this risky? Do you want me to go, Stan?
Yeah,
I mean, so the reason that Fisher & Paykel Healthcare is our biggest New Zealand share investment is because it's the largest company in the index that we track. So that's simply a function of how well Fisher & Paykel Healthcare have done over the last few years. And if another company does better, we'll have more of those. We don't actively choose the investments that we're in. I mean, every analyst has a view on every stock, and unfortunately, they don't always get them right. And in terms of the bonds in various minor countries, that's simply a way of diversifying from any one particular bond. There are thousands and thousands of bonds in our bond portfolio, spread all across the world. The biggest single country that they're invested in is the US, because again, that's the proportion of the index that it represents. But equally, yes, we do have small investments in bonds spread around the world, but that again is just a diversifier. They're all hedged into New Zealand dollars, and they pay their interest in much the same way as New Zealand bonds do. Anything you wanted to add?
And these are developed markets, right? So basically, by diversifying to that, you're basically diversifying your investments across a whole lot of countries, all of whom tax their residents, and all of them who have traditionally in history repaid their debt. So in fact, it makes it lower risk, not higher risk. You know, so just to use 2 examples, if you had all of your money in New Zealand government bonds versus half of it in New Zealand versus Australian government bonds, you've got 2 governments, 2 tax bases repaying that money. In theory, that's lower risk. Now, and if you diversify that, more developed countries get lower and lower risk as a consequence. Yeah.
Richard says, are low interest bond losses in times of high inflation really theoretical? Surely when repaid on maturity, the value of the bond in dollars has fallen in real terms.
Well,
yeah,
yes.
That's true. I mean, real. Yes,
but
you're absolutely right, Richard. Yeah, I mean, if you look at real interest rates, as in interest rates minus inflation, then yes, and at the moment, all bonds are paying negative relative to CPI, the consumer price index. It's the big question is what the underlying rate of inflation will be over the next 10 years, which of course nobody knows. I don't know if you've got any further view, Sam?
I think you are absolutely right, Richard. So that the majority of countries over the last 3 or 4 years have had negative real interest rates, right? So they've actually have been, in theory, after inflation, losing money once the bond is crystallized versus your opportunity cost of investing it in a higher yielding asset. Whether you could have invested in it or whether it was appropriate is a moot point. So you're right in theory. In practice, the point I was making was that regardless of your real rate of return, you're not losing capital value, which is the illusion that you can get when you look at the value of these things. Oh my goodness, I've lost it, I'm never going to get it back. That's not true. You are going to get back the face value of that bond plus the interest, the rate that you bought it at. Yeah, but you're right. That it can have a negative real return for sure.
Jenny, another question from her. What is the rationale for hedging currencies? Apart from being expensive, aren't you still unnecessarily incurring risk by betting that the New Zealand dollar is going to beat the major currencies? I mean, I can make a start on this, Sam, if you like. The rationale for hedging currencies, we only 100% hedge our international bonds, and the reason that they are fully hedged is really because as bonds, the idea is that they are a stable element in the portfolios, and they generate interest, which when you hedge it, you can do pretty closely. Hedging currencies is just a function of interest rates, and so New Zealand interest rates are generally higher than they are elsewhere in the world. And so actually there's a benefit to hedging the New Zealand dollar. It's not expensive in that respect. So within the bond funds, we hedge because we don't think you need the volatility that you get with currencies. In the share funds, we hedge 65% of our international share exposure. And that's because, again, that just steadies the impact of the currency on some of the portfolio, but we do believe that you should have some exposure to international currencies. And so we hedge the average of everybody else in the market. That's our view, which again is as much because currency can be a modifier to volatility in shares. Sorry, that gets a bit technical, but it can work in your favour at times when the New Zealand dollar is not as strong as it could be. Sam, do you want to elaborate?
Yeah. Look, I think the very simple reason you hedge conceptually is because you're going to spend in New Zealand dollars. So you don't want to have your ability to spend or earn New Zealand dollars massively impacted by the currency of where those investments are. So that's fundamentally why people hedge, because you want to hedge back to the currency that you will ultimately need the money in and spend the money in. So that's the simplest answer for hedging, but Andrew's absolutely right. It has been advantageous to hedge into New Zealand dollars up until then. Andrew, can I just jump to the question from Chris? It says, I'd like to see greater clarity and transparency between simplicity living and simplicity investment. To me, there's a conflict of interest. You're running a business as a property developer using simplicity investment funds. This is regardless of the fact that the idea of affordable housing is good. To me, you have deviated from your core business. Any housing market is subject to risk. Well, first of all, we are actually already invested in property developers. So Fletcher Building is a major property developer. So the fact that they're a listed company and we're unlisted doesn't mean that we haven't had some investments in property development. So conceptually, however, the fact that we are owning Simplicity Living and developing it is there a conflict of interest? There's no conflict of interest at all, because our members 100% own Simplicity Living. They 100% benefit from the money that is made during Simplicity Living. There's no profits or side deals or anything being done there. And in fact, Simplicity Living has been a fantastic gift from Shane and Anna Brealey to us. They've effectively gifted the intellectual property and the staff and everything from their business to Simplicity Living. The asset class itself is one which is very traditionally invested in. So there are plenty of pension funds in the world that build, own and operate rental properties. So it's not unusual that we were doing. It's just unusual for New Zealand. And we just happen to be the first. And I think actually other KiwiSaver funds will get into this as well. And then I guess when you talk about the conflict of interest is, could we provide affordable housing and then benefit the renters to the detriment of the members who are funding the building of these houses? That is a very fair question. And so we are very, very careful about making sure that what we are doing is providing, effectively market rents for the longevity of the tenancy. So you would expect there to be a small discount which is applied to the fact that someone will be there for a long time and pay their bills very reliably and be a good tenant and so on. That is ultimately to the benefit of our members who are funding the building and owning of these apartments. It's a very true, once again, very, very accepted overseas, very interesting model. So I hear what you say, but I respectfully don't agree. And by the way, that is the view also of our regulator, the Public Trust, the FMA. Everyone has been through this and has a look at it and recognises that what we are doing is not unusual in an international international context, is not a conflict of interest, and in fact is ultimately to the benefit of our members.
Great. Well, we'd be pleased to know we're nearly at the end of questions. Question from Nick, which is the S&P 500 peaked somewhere in the year 2000 and took around 7 years to break that high. Are there any thoughts on today versus then for those with a 5 to 10 year investment time frame?
No idea what the markets will be in 5 to 7 years time, but pretty confident that in a multi-decade period they'll be higher. But it's a 5 to 7 year time frame is actually sort of a medium time frame, not a long-term time frame. So no, I don't know. It depends a lot on how much we get inflation under control and interest rates under control. And as said in the past, I think the reserve banks and central banks generally around the world are much better at that than they used to be. But who knows whether they'll crack that nut within 5 years.
And I think the last question, unless another one comes through from David, when do you plan to move to other centres for our housing?
Yeah, good question. So we're going to build up a critical mass here in Auckland because we need the systems and processes and building teams and so on. It would make sense to geographically move down the country. So Hamilton and Tauranga would probably be next. We're expanding out of Auckland and then probably down to Wellington. And then after that, who knows what we would do in the South Island there. But there's clear need for affordable rental housing everywhere in the country. We just have to be able to do it to a scale that makes sense and have complete control of the process. So it's going to take some time for us to do that, but we have a long time. We're going to be around here for a very long time. And what we want to do is create an enduring long-term option for New Zealanders. And we want to own, thousands and thousands of these homes all over the country ultimately. But we just have to learn to walk before we can jog and then run. Yeah.
And I'm afraid I did miss one. Sorry, Caroline. She's asking, following up from an earlier question, if they've already paid off their home, is buying a section a good investment?
Would be. I can't give you advice on that. It depends on the section and the price, and it depends on how well land will do versus shares. As I said, over the long term, residential property and has an advantage. I mean, presumably if it's a second section, you need to own it for 10 years before you got taxed now because of the bright line test. But on the assumption that you'd own it for 10 years, property has a huge advantage of being tax advantage. It's what most New Zealanders spend most of their money on. So there's an advantage there. However, if it gets massively out of kilter, then of course, if say shares massively underperform, well, then you will tend to see over time, maybe people will see the value in shares and, buy more shares. So it's very, very hard to know. It's a very personal decision about how comfortable you feel about where your discretionary income should be and what you want to do in life. The only thing I'd say about that is it's not diversifying your investments. It certainly is putting it all into one asset class. But that's what most New Zealanders do with most of their money. Most of our money is in the homes that we own.
Right. Well, unless anything, nothing's come in.
It's a marathon session, 2 hours. Thank you very much for listening.
Yeah.
It was awesome.
Great perseverance, the numbers that are still there.
And for those people that are still there, if I just ask one favour, if you just talk about us so that we don't have to spend your money on marketing and sales, that would be great. If you like what you hear. Yeah. Thanks very much.
Great. Thanks, everybody.
Bye.
Bye.